Hey everyone, so today we're tackling a big one. The two main ways people try to make money with stocks. You've got trading, and you've got investing. Think of it like this. One's a sprint, the other's a marathon. And trust me, figuring out which race you're built for is super important. Let's dive in.
On the surface, it sounds so simple, right? Just buy low and sell high. But how you do that, and more importantly, when you do that, well, that's where everything changes. It creates two completely different ways of thinking, two philosophies, the super fast-paced world of a trader and the slow, patient world of an investor.
And that's exactly what we're going to break down. See, you can be a trader glued to your screen, watching every little price tick. Or you can be an investor kicking back and reading a company's annual report. Both want to make a profit, sure, but their tools, their timing, their entire mindset, they are worlds apart.
All right, first up, let's jump into the trader's pit. This is the fast lane, the high-stakes world where everything is about speed, timing, and trying to catch those quick little price swings in the market.
You gotta understand, a trader isn't trying to own a piece of a company for the long haul. Not at all. The goal is just to profit from the stock's price wiggling up and down. We're talking about holding a stock for maybe a few days, a few weeks, a couple of months at the absolute most. It's all about getting in and getting out, over and over again. So how in the world do they decide when to buy and sell? Well, the trader's weapon of choice is something called technical analysis. They live and die by the idea that history tends to repeat itself, and that pretty much all the information you need is baked right into the stock's price chart. They're basically chart detectives, looking for patterns and clues to guess what the price is going to do next.
And you know, those charts can look ridiculously complicated, but at its heart, it often boils down to something really simple, just like this slide shows. A green candlestick? That just means the buyers are winning the tug of war, and the price is going up. A red one? That means the sellers are in control, and they're pulling it down. For a trader, reading these candles is like watching the market's heartbeat in real time.
And this right here, this is the dream. This is what every trade is supposed to look like. Your chart analysis tells you to buy at 10 bucks, the price does what you thought it would and climbs up. Then your charts give you the signal to get out, so you sell at 13, and boom, a quick $3 profit. The whole game is to do this over and over, stacking up those small, frequent wins.
It totally does. I mean, come on, sounds like a money printing machine. But if it were really that easy, we'd all be millionaires by now, wouldn't we? The truth is, trading is often much, much harder. A chart pattern is just a prediction, it's never a guarantee.
So let's look at a more realistic scenario. You buy at $10, but the price goes the wrong way. Your stop loss, which is like your emergency eject button, automatically sells your share at $8 to stop you from losing more. Okay, you lost $2. You shake it off, you try again, buying at $9, and it drops again. Your next stop loss gets hit. And just like that, two bad guesses have cost you $5. This is the brutal, high-stress side of the game, and it's exactly why so many traders burn out.
Okay, so if that was the sprint, what about the marathon? Let's take a deep breath, leave that frantic world of daily charts behind, and step into the calm, patient world of the investor.
For an investor, you see, buying a stock isn't just a bet on a squiggly line. It's about actually buying a small piece of a real business. The plan is to hold on to that piece for years, maybe even decades, because you believe that a good, well-run company is going to grow and become more valuable over time, building your wealth slowly and steadily.
And the tool investors use is the complete opposite of a trader's. They use what's called fundamental analysis. They could not care less about the daily wiggles on a chart. Instead, they act like detectives, digging deep into a company's financial reports to figure out if the business is healthy, if it's profitable, and if it's actually worth owning for the long run.
So what are they looking for in those reports? Well, they're asking some pretty straightforward questions, like, is this company actually making more money this year than it did last year? For every dollar they make, how much do they actually get to keep as profit? Do they have a strong brand or some kind of advantage that keeps competitors away? They're judging the business itself, not just its stock price.
Okay, let's use a simple example to make this real. Let's say you do your research on a company called WeWe Shoes. You believe in their product, you like their business plan, so you invest $500. Then, you just ignore all the daily noise. You hold on. Over the next 5 years, the company grows, it pays you $100 in dividends, and the stock price triples. Your patience just turned that $500 into a total profit of $1,100. That is the investor's game.
And for the ultimate case study, the poster child of investing, look no further than Warren Buffett. He did not get rich overnight. I mean, look at this timeline. He started investing when he was just a kid. He didn't become a millionaire until he was 32 and then a billionaire until he was 56. That's not luck. That is the result of decades of patience and letting the magic of compounding growth do its thing.
Let's look at something a little more recent. I want you to imagine it's 2008. The very first iPhone had just come out, and you saw the potential in Apple. You decided, you know what? I'm going to invest just $300.
Now, if you had simply held on to that stock, if you had done absolutely nothing but let that fantastic company do its work, that tiny $300 investment would have blossomed into about $22,000 16 years later. That is the power of long-term investing in a strong company.
Okay, so we've looked at both playbooks. We've seen the trader's world of speed and charts and the investor's world of patience and business fundamentals. Now, let's put them side by side for a final showdown to really see the difference.
This table really just lays it all out, plain and simple. Just look at the difference down the line. The time frame, it's a sprint versus a marathon. The method, it's reading squiggly lines on a chart versus reading a company's financial reports. The goal, chasing quick cash versus building lasting wealth. And maybe the biggest difference of all is the effort. One is basically a full-time, high-stress job, and the other is designed to be passive, to work for you in the background of your life.
So, all of this brings us to the most important question of all. After seeing both sides of the coin, which one sounds more like you? What kind of player are you, really?
Look at these two profiles. Be honest with yourself. Do you thrive on that adrenaline rush? Do you have a high tolerance for risk and the time to watch the markets like a hawk, all to chase those quick profits? If so, that sounds like a trader. Or do you prefer the idea of slow and steady growth with way less stress, something you can set and forget while you go live your life? Well, that's the path of an investor.
And it is so important to understand that there is no right or wrong answer here. It's not about which one is better. Both paths can absolutely lead to profit, but they demand completely different things from you as a person. Real success comes from knowing yourself, knowing your personality, and choosing the path that actually fits your goals and your stomach for risk.
And let's wrap up with this thought, because it's the most critical point of all. It doesn't matter if you choose to be a trader or an investor. If you go in blind, without doing the homework, you're not trading and you're not investing. You're just a gambler. The market can be an incredible tool for building a better future, but only if you respect it enough to actually learn the rules of the game you decide to play. Hope this helps, and we'll catch you on the next one.